What I would like to do with this video is to review the trends of the major foreign stock markets and see how they are related to the US stock market. My objective is to introduce a new proprietary indicator. It's really amazing, by the way. It shows how the close relationship between the global business cycle, foreign equity markets, and the US stock market. In order to be able to forecast the likely trend of the market, it's important to fix some important reference dates. Okay, this one is the main recession of 2008, 2009. Then there was a slowdown in 2011, 2012. There was another global slowdown, 2014-15. And according to this indicator that is published by the OECD, the economy, the global economy started slowing down in 2008. And it looks like it's still being very weak. This is I think is an amazing indicator. I'll tell you why. Because it's computed using internal data of the US stock market. So they're not fundamental data, breadth kind of indicators, how many stocks go up, volume, that kind of information. Now, why this thing is amazing? Because again, it's not an economic indicator yet. If you look at the main trends, this gauge started being strong in 2002 when the economy strengthened, then weakened in 2008, 2009 during the recession of 2009. As I mentioned before, it reflects a slowdown in 2011-12. It reflects another slowdown in 2014-15, and of course there is the slowdown which started in 2008. What is to me is impressive is that this indicator shows that market players, market investors know and react willing or unwilling about economic forces, and these economic forces are reflected in internal market information, which is, by the way, why people talk about momentum is successful. Momentum is successful because the market momentum reflects these long-term cyclical market forces. This technical indicator of the market can help to identify the strong periods of the US stock market and the weak period, because when the indicator rises, means the economy is strong, means earnings are strong. Then when it starts slowing down and reaches this point, it means that now the economy is on the verge of a serious slowdown in earnings. And sure enough, you see a market peak here. Then there is the actual, here in this particular period, there was a recession. Coming out of the recession, you have, again, the same, the economy strengthens. Then there is a relapse of 2011, 2012, and there is a little bit of uncertainty here in the marketplace. Then there was this slowdown, and then here the economy now picked up again. It rose, earnings strong. Then there is a slowdown of 2014-15 when people were even afraid of a recession. And sure enough, at this point, you have market uncertainty here. Then the economy comes out of the period of slowdown. There is a strong growth, earnings, and then it comes down again. And this is when you have another period of uncertainty in the market because there is an economic slowdown coming in 2018. What is interesting is that now this gauge seems to be telling that we might be in a period like this one, this point here, or here. And every turning up is an indication that there is going to be a big move in the stock market. I sincerely hope so, but it's not a sure. Time will tell. Just stay tuned and let's see what happens. Let's apply the previous indicator to the main foreign markets. And again, the strength of the the cycle here. This is a point where you have to be careful for South Korea stock market. The economy is strong and then relapses, and then this is when you have to be careful. And then there is not much action here. And then when the economy started improving again and then slowed down, and sure enough, from here to here, the market was strong, but this is when it peaked approximately at this point. With foreign markets improve because this indicator turn up, again, remains to be seen. The same story applies to Japan. This gauge goes up and then reflects a slowdown in the global economy, and sure enough, at this point, there is the Japanese stock market doesn't do much from this point on. Then the economy, the business cycle improves, and the Japanese market improves. This improves again, and then it comes down here, and this is where this Japanese stock market stops going up. The economy improves again in the global business cycle, but then it slows down, and sure enough, the Japanese stock market at this point stops acting well. So this is a gauge that can be applied also to the Japanese equity market. The same can be said if this gauge turns up. Obviously, it would be good news for the Japanese stock market. Let's see now if this proprietary indicator to measure the global business cycle applies to the German market. And as you can see, this applies quite well. The economy slows down, the indicator gets to this point, and this is where the stock market doesn't do well. There's another crossing point here, and the German market stops acting well. There is another crossing point here, and the German stock market doesn't acting well. The time the equity market, the German equity market, is when this gauge rises and then up to this point. This is when it stops acting well. Now, the fact that there is a turning point here, there might be a turning point here, is something to look at very, very carefully. Well, by now you would not, I'm sure you're not being surprised. You're not surprised if I tell you that the global business cycle, as measured by this gauge, applies also at the UK stock market. Here, period of pause, beginning of the period of pause, beginning of a period of market pause. The time to be in the marketplace is when this gauge rises, goes up, and then up to this point. This is when begins the correction or the trading in a narrow range. So the time not to be in the market is during this period when this gauge declines below the dotted line, like here, and like here. Right? When is the time to be in the marketplace is when this turns up, like here, like here, like here, and like here. Is this going to be a turning point? Hard to say. We'll have to see. Stay tuned on that. The indicator showing the global business cycle applies also to the Chinese stock market. By the way, there are not enough data for their equity market, but you can see how the same pattern applies to their stock market. When the global economy slows down, the stock market pause. The global economy slows down, the market pause. The economy slows down because of the 2015 14-15 slowdown, the market pauses, and the same thing can be said here when there is a slowdown of 2018-19, the economy slows down, and of course the equity market stops. Obviously, if this turning around could be, let me repeat, could be a sign the Chinese stock market might be will continue to head higher. Well, obviously this gauge is very, very powerful because it applies also to Europe. Here, slowdown, global slowdown, the market peaks. Slow down here, in 2011-12, the European market stopped doing anything. The market, there is a slowdown in 14-15 in the European market, stopped acting well. And of course, the 2018-19 slowdown in European market acting well. And like in other markets, the time to be that is profitable is when this gauge rises, then showing the slow economic and earnings slowdown until this point. So you have all this period to profit from the stock market. Now, is this one of those periods? Well, time will tell. This story applies to the emerging markets. As you can see, the crossing apply to periods of market slowdown. Here is another top, and this is another top. Again, if you want to be in the emerging markets, you want to be during this period here, or when it rises and then up to this point. What I have shown is a very special indicator based and computed from technical data, again, non-fundamental data about the U.S. stock market. This indicator reflects the U.S. business cycle and is very closely connected to the global business cycles. So, as a consequence, it should come as no surprise to see the major turning points of the U.S. and foreign stock markets take place at the same time. This presentation is available free of charge by just going to the website www.peterdack.com, where I have saved you can review all the videos that I have made. Much of the concepts that I discussed in this videos and the previous videos are discussed in detail in the Peter Dack portfolio, www.peterdack.com, and in my 3 books, Profiting in Bull or Bear Market, Easy Ways to Beat the Market with ETF, and Investing Wisely, It is Easier Than You Think. Again, thank you for listening, and I hope to see you very, very soon. So long.